Welcome to this, the second in our series of videos looking at the joint IASB and FASB leasing project. This series of videos focuses on the potential impact of the proposals for technology companies. In the first video, we introduced the dual models and the right-of-use models for the lessee. And we noted that lessees will recognise a right-of-use asset and a lease liability at lease inception on all leases other than short-term leases and leases that are out of scope. In this second video, we'll look at more detail at some of the aspects of the new leasing model. Let's look at an example of the accelerated model for the lessee. This shows the individual impact of the accelerated model on one example lease of a store. If you've been watching the first videos, you may well be asking why we are applying the accelerated approach to a property lease. Typically, property leases may well fall under the straight-line model, but in this case, we've assumed that the lease is for all of the remaining life of the property. So this is an example of when the accelerated model would be applied to a property lease. This model will apply to all other non-real estate leases that are in scope. The example assumes a data transition of the 1st of January 2012 for a lease with 7 years remaining. Annual lease rental is approximately £400,000 per year. This shows the current treatment under IAS 17 as an expense, shown in light brown, an equal charge each period over the life of the lease. It also shows the treatment under the accelerated model, which is built up in stages. The interest expense in blue and a right-of-use asset amortisation charge in purple. The total is the green line, and this shows the front loading of the lease expense. And this is greater than the lease rental until 2015, where the graphs cross over. In addition, the right-of-use asset and lease liability is approximately £2.1 million at the 1st of January 2012, and this is just for one lease. So the impact of applying the accelerated model can be quite significant. So we've seen that all but short-term leases will result in a right-of-use asset and a lease liability being recognised on the balance sheet of the lessee. We should look at how to measure the initial lease liability and the right-of-use asset. The initial lease liability is the present value of the future lease payments. But which payments? It will include expectations about lease terms, the purchase options, residual value guarantees, and termination penalties. Variable lease payments would also be included, but only if they are based on a rate or an index, or they are in substance fixed. And there is a higher threshold for including optional periods in the assessment of the lease term. The lease liability will subsequently be measured at amortised cost, modified for certain reassessments. The right-of-use asset would initially be measured as the sum of the present values of the estimated lease payments, as before, but plus the initial direct costs of obtaining the lease and less lease incentives. The subsequent measurement of the right-of-use asset and the expense recognition is dependent upon the lease classification, either the accelerated model or the straight-line model, as we outlined in the first video. For the accelerated model, the right-of-use asset is amortised over the shorter of the lease term or the economic life subject to impairment testing. This is as we showed in the example lease earlier. This, added to the interest costs, will give the accelerated income statement impact. For the straight-line method, the approach needs to be different. The income statement needs to be on a straight-line basis. To achieve this, the right-of-use asset is considered to be linked to the liability throughout the lease term, with the right-of-use asset subsequently measured as a balancing figure to give a straight-line lease expense. Having worked through the core accounting concepts, let's consider some of the more practical difficulties technology companies will face implementing these proposals. For technology companies, the distinction between provision of a service and leasing an asset can be key. IFRIC 4 currently gives guidance on identifying embedded leases within contracts that are not in the legal form of a lease. IFRIC 4 will be replaced by the notion of a specified asset controlled by the lessee. Given that for all but insignificant or short-term leases, a right-of-use asset and a lease liability is recognised by the lessee, the decision as to whether there is a lease or not will now drive the recognition of a lease liability. There are likely to be practical challenges to determine variable lease payments with reference to an index and how to treat the variations of the lease payments. This may need reassessment over the life of the lease. Also, as the lease liability is recorded at present value using an incremental borrowing rate as the discount rate, companies will need to make a determination of the incremental borrowing rate to apply to each of their leases. With more leases coming on balance sheet, companies will need to watch for leases in foreign currencies, which will be subject to foreign exchange movements. Companies may need to consider hedging the exposure to foreign exchange movements and, if necessary, hedge accounting. And lessees will need to consider, with more leases coming on board for all but short-term leases, they'll need to consider the impact on banking covenants and the ability to borrow. The treatment of leases and lease liabilities will also impact distributable reserves, which will need to be monitored to ensure no issues arise. In the UK, tax legislation will initially be based on existing legislation, and therefore dual tax and accounting records will need to be maintained. This could represent a significant administrative burden for companies. This also highlights the need for companies to consider the extent of their current systems in place to monitor leases and whether they will need to be enhanced. That's the end of this video looking at the proposed leasing models. We look forward to the publication of these proposals in a revised exposure draft in the first quarter of 2013. There is a lot for technology companies to look at. It will be necessary to consider the treatment of leases, particularly for longer-term leases, in advance of the application date. Thank you for watching this video.